With 2020 quickly coming to an end, time is running short, but what year-end financial loose ends should you be checking on before the end of the year? That's our investor question. Welcome to YCG, where we help your capital grow so you can achieve your financial goals. If that's something that interests you, then hit that subscribe button and the bell notification so that you don't miss a thing. I'm Will Kruger, Chief Executive Officer here at YCG. The month of December brings in the holiday season, but it's also a great time to proactively assess where you or your business stands from a financial standpoint. We're going to give you 7 proactive financial planning tips that could be incredibly helpful for your personal finances or business to do before the end of the year. But as always, do check with your financial or tax advisor, as each individual's circumstances are unique. I don't believe in free lunches, but you're going to want to stick around because my final tip will be about how you could possibly receive 100% return on your money in the first year of saving, giving you your personal finance free lunch. Tip number 1, start your retirement plan now. As you know, on this channel we discuss investing. If you haven't started a retirement plan, don't let 2020 close out without taking this important step. There are many ways to do this. If your employer has a 401k plan and you qualify to participate, enroll now, and if you can, contribute the maximum amount the program will allow. In 2020, the maximum amount you can contribute to a 401k is $19,500. If you don't have a 401k plan available, you can contribute $6,000 to a Roth IRA, $7,000 for individuals over 50 years old. But remember, the income limit to qualify for a Roth IRA must be less than $139,000 modified adjusted gross income for single filers and $206,000 for joint filers. For a traditional IRA, your contribution limits are the same as a Roth IRA, $6,000 for those younger than 50 and $7,000 for those older. If you're self-employed, it's never too late or too soon to set up a retirement plan. Some plans might be established before December 31st, but you can postpone funding until April 2021 and still claim the tax benefit on your 2020 tax return. If you need help with this, reach out to us here at YCG. We can help you determine what retirement plan might be right for you and your business. Finally, for those of you with IRAs or other retirement accounts, now is a great time to make sure your beneficiary designations are up to date and accurate. Family dynamics change over time, such as divorce, so make sure you have the right people who are designated to benefit from your retirement in the event of your passing. Tip number 2, tax loss harvesting. Realizing or selling your securities that have losses can help offset and lower your capital gains, which in turn will lower your taxes owed come April. This year we've experienced volatility that we haven't seen since the Great Recession in 2008 and 2009. It's a great time to review your investment portfolio and realize any additional capital gains or losses before wrapping up the year. If you find yourself with net realized capital losses for the year, remember you can only reduce your ordinary income by $3,000. The remaining capital loss will be carried forward into a following year. If you anticipate that you will be in a higher tax bracket next year, it might be better to carry the capital loss into next year to help offset capital gains in 2021 instead of taking the capital gain this year. Tip number 3, contributing to your IRAs and your Roth IRA conversion. As I mentioned in my first tip, make sure you're contributing the max contribution limits or as much as you can afford to save to your retirement accounts. We recommend you create an automatic saving plan where each month you have dollars electronically transferring from your payroll or your checking account to your retirement account so that it's something that just happens and you don't think about it. You'll be amazed at how quickly your saving and investment retirement account will grow and compound in this way. Contributing to your traditional IRA also reduces your taxable income, which will lower your tax bill. The Roth IRA conversion continues to be a fantastic planning technique for certain taxpayers. This provides tax-free income during your retirement and provides greater flexibility than a traditional IRA. In the current market environment, where asset values may still be low, and with the potential that tax rates may increase in the future, converting assets from your traditional IRA to your Roth IRA appears to be more attractive between now and the end of the year than ever before. Remember, you pay taxes at the time of contribution to a Roth IRA, and then 100% of the Roth contribution remains in the account, growing tax-free for the benefit of the taxpayer. You also have less stipulations on a Roth IRA come your retirement, such as tax-free withdrawals, and there are no required minimum distributions. Tip number 4, charitable giving. We just had Giving Tuesday earlier this month, and for taxpayers thinking about making a large charitable contribution, 2020 offers a great opportunity to do this. Unlike other years where charitable gifts are limited by a percentage of your adjusted gross income, charitable donations made in 2020 to qualifying organizations are 100% deductible. So if you do decide to make a large donation, this offers a great opportunity to also lower your overall taxable income for this year. This is a great win-win for everyone involved. Tip number 5, 'tis the season to give. Staying on the topic of giving, if you're in a fortunate position where you're looking to reduce your estate tax exposure, remember you can give up to $15,000 to as many beneficiaries as you'd like every year without paying a gift tax or decreasing your lifetime estate tax exclusion amount. This is the government's way to incentivize gift giving without triggering a tax impact. Remember, there is no catch-up mechanism, so once the year is over, your opportunity to give this tax-free gift ends. Tip number 6, perhaps it's time to buy that printer for your home business. What we mean by this is if you have a home business or side business, take a look at your P&L statement now. Get it reconciled so you won't be surprised by lower expenses due to this year's pandemic and perhaps higher taxable income, and as a result, you'll pay higher taxes than expected come April 15th, 2021. Now might be the right time to squeeze in any large business expenses you've been considering, such as buying that laser printer you've been eyeing for a while now. By paying for qualified business expenses before year end, you will lower your overall 2020 taxable income. Okay, tip number 7. It's your free lunch time. What we're talking about here is your employer's 401k matching opportunity. We recognize this may not be available or applicable to all of you, but for those of you with an employer 401k matching program, you should absolutely be taking advantage of this. An employer matching program is like getting 100% return on some or all of your contribution. Depending on the employer's matching level, if you aren't contributing enough to receive the full employer match, you should check on whether there may be a catch-up opportunity before year end. Not doing this is essentially passing up on free money, so go do it. Thanks for the great question today. Leave your comments below and check out our other videos. We'll see you in the next time.